Good afternoon, everybody, and thank you for joining. Hopefully, you'll find this to be an informative session. As Justin said there, with all the leaking, probably the element of shock and awe had gone out of it. But on the whole, I think it's fair to say it was a budget that was eagerly anticipated. So much so I think that they brought it forward a few weeks even from the normal mid-October date. In terms of what was announced, it was an €11 billion package, so it was big, in that regard, probably one of the more dramatic budgets. But as we just said, with all the leaking, probably the element of shock and awe was taken out of it a little bit. What we'll try and do here today is have a look at some of the headline measures with a particular focus on how they impact, say, solicitors, both from your personal tax affairs, but also maybe in terms of how it might impact to some degree on your client work, because some of these changes could impact in that regard as well. So I think we'll begin here with the just a whistle-stop tour of the main income tax changes. Now, you've probably seen these, or most of you have probably seen these on the various television programs and last night in newspapers and so on, but we'll just skirt through them here. The big change in income tax was the widening of the bands, or the standard rate cutoff point. So this is the point at which you start paying tax at 40 rather than 20%. And there's been a significant enough increase in those bands. It's gone from, essentially for a single person, it's gone from 36,800 up to 40,000, with pro rata increases for married couples. So a married couple can go up to 80,000 if they're both earning, with the single earner potentially going as high as 49 before they start paying the high rate of tax. And they're quite significant. I mean, that effectively puts €640 per annum into the pocket, say, of a single person who's earning more than €40,000, and potentially twice that for a married couple. They also made some changes to the tax credits. Essentially, the headline tax credits have gone up by €75 each. So they would be your standard credit, your PAYE credit, and your earned income credit. And most people would be getting two out of those three. They'd be getting their standard credit and either the PAYE credit if they're an employee, or the earned income if they're self-employed. So it's essentially an extra €150 into their pockets, and a little bit more if you're married. There's an extra €75 there potentially for a one earner married couple. So modest changes to the credits, maybe a little bit more significant changes to the bands, very modest change to the USC, essentially the 2% band, where 2 becomes 4.5, if you like, that's been pushed up a little bit to take into account the increase in the minimum wage. It effectively puts €40 per annum into people's pockets, so it's a technical change as much as anything probably, but so they're kind of your headline changes. The home carer credit as well has gone up by €100, but otherwise kind of steady as she goes. No change to the tax rates or anything of that nature. Although, as we'll see in a minute, there are references made to kind of a future review of the personal tax system and the famous 30% rate that's been mooted.
Michael, just an obvious question there, like when are these changes due to take effect? And just have a question out there, if people could ask a question on the chat. We're just having a few technical problems with it, so I just would love to know if it's working or not. And if you're having a problem sending a question, you can send it to my email, j.purcell@lawsociety.ie. If the chat isn't working, or raise your hand. Thank you.
Yeah, just so they come into effect on New Year's Day. So these are for the 2023 tax year, essentially. These changes come into force. Yeah, I was actually thinking of that last night, and we were talking about kind of the next period of time and putting money into people's pockets. And I was just thinking, well, the tax changes won't actually go into force until January, but yeah, so it'll be the next tax year. But one that does come into effect in 2022, even though it's for 2023, is the rent credit. So this is probably one of the flagship measures, and it was mooted in advance that they would try to do something in the area of rent, and they have. So they've introduced this rental tax credit that effectively, for anyone who's renting at the moment, is probably going to be worth €1,000, because it's been introduced with effect from January 2023 for the 23 tax year only, but he has backdated it for 2022 as well. And essentially what it is that it's the amount of rent you pay in the year at 20%. That's your credit, but the credit is capped at €500. So effectively, anyone who's paying €2,500 or more rent in a tax year will get this €500 for 2022, and provided they're still renting next year for 2023. It is for each tenant. So if you were renting a house to 4 people, all 4 of them can claim in their own right. If you have a married couple, the married couple can claim essentially twice the amount, regardless of which of them is paying the rent. So it's useful. We'd actually had a rent credit in the distant past for many years. It was essentially phased out with effect from I think the December, what we call sometimes the IMF budget, the December 2010 budget. It wasn't actually abolished. They actually phased it out, and I'd forgotten myself. It was actually only in 2017 that it was completely wiped out, albeit in the last few years of its life, it was a very modest amount. So this is more significant here at €500 for at least for 22 and 23. There was talk he tried to do something for small landlords as well. That hasn't materialized. It looks as if they looked at various measures but weren't able to get them tweaked in time. There was a modest change, I think, for pre-letting expenses, which they started to allow a few years ago to a certain extent. I think they have doubled the amount of those that can qualify, and I think they've you can go back 12 months rather than 6 months, but look, that's a fairly minor change. It'll be interesting to see if they do introduce any changes on the landlord side. Not sure about the finance bill in a few weeks' time, maybe later than that, but it's something probably that will keep cropping up, but nothing in yesterday's budget. Business taxes, maybe these aren't immediately impactful for the legal profession, but it's useful to be aware of them probably as a backdrop. A couple of changes introduced, headline measures, which are subject to the legislation, which we haven't seen yet. We'll see that I think in the finance bill in around the 20th of October. So it is subject to legislation. In some cases, there's EU approval required, but if they follow through on what was stated in the budget yesterday, some of these could be quite significant and in fact quite welcome for businesses. So enhancement to the R&D credit regime, particularly for SMEs. The Keep Share Option scheme is being enhanced and extended. And again, if they're good to their word, they could actually be quite useful changes. And then finally, the knowledge development box, which is part of our intellectual property offering, along with the R&D credit. It's a special 6.25% rate for products that are developed through certain R&D processes. So it's a little bit niche. That's being extended for another few years, but the rate might have to go up to 10% if our headline CT goes up to 15%. But just a couple of interesting announcements made in that area yesterday.
Michael, just for those, including myself, who don't know what a keep is, what's a keep?
So keep, Justin, is on first principles, if an employer gives shares in the company, in their own company, to an employee, it's benefit in kind, so it's income tax at potentially 52%, including PRSI and USE. But that tax might be payable when the option is granted, or more likely to be payable when they exercise it. With keep, what it does effectively is two things. First of all, the tax isn't payable until they actually sell the shares. So it's a share option scheme. It's an option to acquire shares in the company at today's market value. And the idea is that hopefully the shares go up in value over the next number of years, at which point you exercise it, but you only pay today's market value, which is much cheaper. The amount you've saved in a normal share option scenario, that's income tax. But with keep, it would be capital gains tax at 33%. And furthermore, will only be payable if and when you actually sell the shares. So it's an interesting scheme. It was brought in 2018. It's had a number of teething problems. Potentially the changes announced yesterday could make it a little bit of a game changer. In particular, the big conundrum with all share options is how do I cash them in? If you're in a PLC, that's absolutely fine, but keep is very much aimed at SMEs, so there isn't a market in the shares. The big question was, would they allow company buybacks of the shares? And we didn't think they would, but they announced yesterday that they will. So it'll be interesting to see what form that takes or what the conditions are, so that the employer himself or the company itself could buy the shares back after a number of years. And therefore that triggers a liquidity event for the employee and gets them 33% CGT rather than income tax. So it could be a welcome.
So there was though, and I don't want to steal your thunder, some extension to if I'm an employee that I can get a benefit tax free from 500.
That's a fair point, actually. That was another one. So this is what we sometimes call the Christmas voucher scheme, though it's not only for Christmas. Yeah. So this is where an employer can give the strict phrase is a non-cash benefit. So it could be other stuff, but it's normally vouchers. You can do that at the moment once a year, up to a maximum of €500. He's doubled that to €1,000, and also provided that you can now do it in 2 separate vouchers. And the reason he's done the 2 separate vouchers is because it's actually coming in immediately, so, or in 2022. So if you've already given your employees a €500 voucher this year, you can actually do it a second time. So yeah, that is welcome. That is welcome, because it's a way some employers have of, I suppose, kind of Christmas bonuses, that type of thing. It's popular for. It's a tax efficient way of doing it, because if you're going to give someone a €1,000 bonus nowadays, they're going to go home with €480 probably in their back pocket if they're on the top rate of tax. Whereas if you give them the voucher, they've got €1,000, and you as an employer save employers' PRSI of up to 11.05% as well. So, it's a nice one. And there was a good bit of speculation and, dare I say, to use the word, lobbying for that to happen over the last kind of couple of months, and it did. He announced that yesterday, so that's welcome as well, I think. One of the big flagship measures yesterday is TBS. So we've had all of these SS schemes over the last few years, and they've all been COVID related, which are TWSS, your EWSS, and your CRSS and BRSS, various schemes. So we've got another one now for electricity bills, effectively. So this is your temporary business energy support scheme. Essentially has been introduced to help businesses who are suffering from increased and increasing energy bills. And it's going to be administered by the revenue commissioners, similar to all of the COVID schemes. Now, it's been backdated to 1 September 2022 and is to run until at least 28th of February 2023. And the way it works is that, first of all, the conditions, so you have to be tax compliant, as with all these, but also, interestingly, you have to be carrying on a case 1 trade. And that's very clear. Both he said that, used that phrase specifically in his speech yesterday, and it's in all the budget papers afterwards. The only thing is we haven't seen the legislation. That's a subtle point, case 1 trade.
Never heard that before. What does that mean?
Yeah, so apologies for tax jargon here, but the different types of income sources that you have are given a special class under tax law. So Schedule E, for example, is PAYE. Schedule F is dividends. Under Schedule D, then you have the 5 cases. Typically, cases 3, 4, and 5 are investment income types. For example, case 5 is rental and so on. Cases 1 and 2 effectively is business income, and they're like Siamese twins. But there is a subtle difference. Case 1 is a trade. Case 2 is a profession. And the obvious thing here is, hold on a minute, you're saying this applies to case 1 trades, but therefore, does it not apply to a profession? And that obviously brings the solicitor's profession into play. And it appears initially, at least, that it might not apply to the professions. Now, again, subject to the legislation, but...
So this is different to a NACE code, which describes the business type that you have. This is a tax classification.
Exactly, yeah, exactly. Correct. So again, that's something that is probably worth watching out for over the next few weeks. We haven't seen any legislation for this. We haven't, or financial instrument or whatever, but it would be interesting to see the exact detail,
Yeah. And so this will be revealed in the Finance Act, or probably sooner, when people maybe figure out that they're applying the sort of limiting factor to it.
Yeah. And if you
I can't see them getting away with that, to be honest. It doesn't sound right. But yeah,
I know the thinking they have behind it probably is that that what they're really targeting here are kind of the energy intensive businesses, the likes of your hotels and your manufacturing businesses and so on. Now, there is a separate scheme for larger businesses. It's a grant scheme that's going to be applied by Enterprise Ireland, but this particular one is, they're saying case 1 trade, but like
But isn't it, Michael, that you have to demonstrate that your unit cost has gone up 50%?
That's right. So they're your conditions. So assume you are a trade and you're tax compliant, and you now go and you apply. So you register with the revenue commissioners, and they will apply the refunds, and you make your application. The conditions are that you compare your electricity bill in 2021 with your, I used the word energy bills in 2021 with your energy bills in 2022. So gas and electricity, effectively. So you compare the actual period with the actual period. So you, for example, your September 2022 electricity bill, you compare that with your September 21 electricity bill. What you're actually comparing is the average unit price that you're being charged. And if that unit price is more than 50% or 50% higher in 22 versus 21, then you qualify for this particular scheme. And the rebate you get from revenue is 40% of the increase. Okay, so that's the payback as such that you get. Now, in addition to legislation, Justin, I think if you think back to TWSS and all the various other Corona schemes, I think you'll recall that, particularly the TWSS, I think the revenue were constantly updating the guidance and dealing with real life scenarios and so on. And I think by the time TWSS finished in August 2020, because remember, that was the original scheme that only ran for kind of the first phase of the pandemic. I think by the time they finished with it 5 months later, they had 18 different variations or versions of the guidance notes. So you could see this having an element of growing legs as well, you know. But certainly on first principles, that's what it's aimed at, is trading businesses that have this increase. You'd imagine a lot of businesses will qualify, but someone made the point to me yesterday that some businesses have managed to sort of hedge their electricity bills in some form or other. They may not actually qualify for it, but if they haven't gone up by enough as such. So but
all to be revealed, Michael, I think, in this one. I think
yeah, exactly, yeah. But that's certainly
quite a few terms and conditions in it. Yeah.
Yes, exactly. Yeah, exactly. There will be, yeah. You know, so again, we'll have to wait for that, and the devil is in the detail, as they say. So moving then to, suppose, some of the client-facing issues that might apply for solicitors, and there are a number of them here in the area of property. Actually, it wasn't a particularly property-heavy budget or a heavy focus on stamp duty, but there were a couple of subtle changes introduced. And one of the things that was done here is the residential development stamp duty refund scheme. It's a bit of a mouthful. Was due to run out on New Year's Eve. It was extended for another 3 years. What is that? In simple terms, what that is that a couple of years ago, they put up the rate of commercial stamp duty initially from 2% to 6% and then up to 7.5%. And if you buy land and it's not resi land, it's not residential property, there's no residential property on it, that land is itself essentially commercial, it's non-residential, and you pay the 7.5%. But what if you buy it and you build property on it, which revenue the government are very keen that people would do? They want as many houses built, I suppose, as they can. Well, if you buy that land and you do start building houses on it, then you can get a refund of the stamp duty, so that effectively you only end up paying the 2%. And in simple terms, when you buy the land, if you commence building residential property, having received a commencement order from the local authority within 30 months, that's 2.5 years, then you can apply for a refund of your stamp duty, provided that you come, and then a condition of the refund is that you complete the building then within the further 2 years. So it's an interesting one. It's been there, and it's something that solicitors are supposed to be aware of if you're buying property for people, that you have this, that the rate is actually 7.5 on the land, but that there is this potential refund. And just to bring it to their attention, I suppose. The residential zoned land tax as well was introduced 12 months ago. This is a 3% levy effectively on certain land within certain zoned areas that's not being put to a residential use. So it's to encourage development. That was introduced in last year's budget, and he said that the maps of the affected lands would be released by local authorities. He said yesterday they're going to start coming on stream on the 1st of November this year, so just be aware of that as well. Vacant homes tax has been introduced. So this is for residential properties anywhere in the country that are occupied for less than 30 days, so less than a month in any 12-month period. And if that is the case, then you have to self-assess for this vacant homes tax, and it is applied. It'll be essentially 3 times whatever LPT is payable on the house will be payable as a vacant homes tax. And that is self-assessment. So from a solicitor's point of view, how could this be an issue? Well, you know, when you sell property, you know that the LPT is a charge on the property and has to be discharged before the sale goes through and so on. This would be similar. This is another one on top of that. So just be familiar with that. Those other taxes we've discussed here, those could be relevant in that regard as well when you're buying or selling property for your client. Or, and this is one that could really bite you where it hurts, solicitors sometimes, I think, buy property for people as nominees. And when that happens, the property can go into the solicitor's name. And the LPT system, because non-compliance with LPT triggers issues like tax clearance certs not being issued or late filing surcharges on your income tax returns because you're not LPT compliant, sometimes the revenue system will recognize the house as belonging to you, the solicitor, even though it doesn't really. And it can cause all of those problems with tax clearance and surcharges and so on. So just be familiar with that, with all of those issues as well, you know. We thought there might be CAT changes yesterday in the budget. from a compliance point of view, which would be something that would impact solicitors, which is that the tax strategy group papers in August, and indeed the Commission for Tax Report and others have been saying, look, this requirement currently that other than where you're claiming business relief and agricultural relief, you only file a cash return if the total lifetime gifts and inheritances you received are more than 80% of the class threshold. So for example, the parent and child, which is 335, it's only once the accumulated goes above 268 that you're obliged to file a return. They all now want that to be introduced for all returns. Even if you're making a small, a more modest gift, I'd say anything above the €3,000 small gift allowance, they want a compulsory filing to be introduced. Didn't come in the budget yesterday. Might it come in the finance bill? It might. It's certainly something that's on the radar. So again, be familiar with that down the line, because again, as solicitors, you're dealing with probates, you're dealing with inheritances and so on, and indeed gifts as well in some cases. Just be familiar if that comes in with those filing requirements. Other things that were alluded yesterday, we obviously saw the Commission for Tax Report last week. It was published, ruffled a few feathers, I think. A lot of the things are probably politically unpalatable, but he just acknowledged it yesterday, said it was never intended for the current budget, he said, but it's something that he'd be delving into and reading up on kind of in the coming period. So it is something that's relevant, I suppose. Ultimately, all of these supports have to be paid for, I suppose. Pensions have to be paid for. So again, there could be a lot of hard choices to be made down the line. He did, however, also state that he has an ongoing review of the personal tax system to report back to him, and that they're carrying that out in the department, and also internally in the department and with the revenue, that he's commissioned a review into a possible introduction of a 30% income tax rate, which the Taoiseach was talking a lot about there in recent weeks. Didn't get introduced yesterday. The introduction of a third rate of tax does create a lot of administrative burdens, both for revenue and for employers. And it's probably not something they can introduce quickly, but they've done a preliminary review where he said that they've concluded that it is something that could be introduced from an admin perspective. It would be doable for the 1 January 2024 tax year. So he's asked for this review to report back to him by the time he makes the summary economic statement next summer, and then he'll consider it in next year's budget. Again, interesting times.
So we're at 1:20. If anyone has a question, we'll take it on the chat or raise your hand, or you can email it to me at j.purcell@lawsociety.ie. So thanks, Mike.
Yeah. Okay. Yeah. I mean, I suppose the last bit I have here, or the last section, is one that it's like the trunk wielding mammal in the corner, and it could be particularly relevant to a lot of businesses indeed, and including solicitors. It's not immediately related to the budget yesterday. In fact, there was nothing in the budget about this yesterday, a change from the previous two. Tax warehousing. So you'll recall that VAT and PAYE liabilities could be warehoused during the pandemic. I think, in fairness, for the legal profession, it was probably the warehousing of VAT and PAYE was probably more relevant in that phase one from March to August 2020. But you may have some VAT and payroll taxes warehoused. Also, income tax. You were allowed to warehouse that in certain circumstances in what I call your November 2020 interaction, or if you want to be precise, it was actually December that year. Your pay and file, your income tax deadline, your interaction with the revenue, the tax that you normally would have been paying in November 2020 and the tax you would have normally been paying in November 2021. In certain circumstances, if your income was down 25% relative to 2019, you were allowed to warehouse that as well. And indeed, many solicitors, I think, may have done so. So the rule with warehousing was, broadly speaking, it ended on last New Year's Eve, December 2021, and the warehouse was then locked for 12 months. In other words, all the stuff that was warehoused in the COVID era up to last New Year's Eve was locked away for the 2022 calendar year, zero interest accruing on it, which is great. But then the doors of the warehouse will open on New Year's Eve 2022, and that's only a couple of months away now. And suddenly it becomes payable. And what is the story with that? Well, essentially, on 1 January 2023, all of that tax is due. It's no longer a warehouse liability. So you either have to pay it or you have to agree an instalment arrangement with the revenue commissioners. Now, in the July stimulus back in 2020, they put a lot of this on a statutory footing, and they introduced a special reduced rate of interest on warehoused debt of 3%. It's normally between 8 and 10%, depending on the taxes involved if you're late paying tax. So from 1 January 23, the rate, if it stays unpaid, is 3%. What may be overlooked in some cases is that they didn't say that you're entitled to an installment arrangement. They said if you pay this debt by installment, the rate would be 3%. But you have to apply for an installment arrangement in the same way as you would have done for any other, what we call pre-2020 debts. And it's at the discretion of the revenue, and you have to make your case. And you apply using a form PPA1. So when you apply for your phased payment arrangement, your PPA, you have to make a proposal yourself as to what you think is fair, and then the revenue will consider it and you'll agree it between you. So what is actually the terms that will be applied to a PPA for this warehouse debt? It's a case-by-case basis. Revenue have given some guidance that's a little bit vague. They've said they'll expect a down payment of between 25 and 40%. And that's not out of line with what would have traditionally been the case. Back in the old days, kind of back before 2010, most people regarded 25% as the rule of thumb standard down payment that you had to make. In 2010, in the midst of the last recession, they put this on a more formal footing when they introduced the PPA1 form, and revenue started pitching for 40%. Now, in many cases, you bid them down to 25, but they're now saying for this, they're saying, yeah, between 25 and 40% down payment. And the balance they're saying over a period of time, which they say would be no longer than 3 to 5 years. Now, I'd hold up a warning cards there. 3 to 5 years is probably really pushing to the outer limits. More traditionally, we're used to seeing PPAs going to 2 years, and at a push, in difficult cases, 3 years. Now, we have seen them going longer in some hard cases, but just be wary that 3 to 5 probably won't be revenue starting point. So again, in that regard, you have to give it some thought, and now is the time to think. The warehouse will open on New Year's Eve, but this isn't a Christmas issue. This is a Halloween issue, if I can put it like that. Maybe apt descriptions. But the revenue are going to start writing to people in October, anyone who's warehoused. And I've actually seen the first letters being released this week. And they're going to write to you asking you, what are you going to do about this, or what are your proposals, guys? So you need to yourself as a business look at, even leaving the revenue side for a minute, what's realistic for your business? What would work? What are cash flows looking like, and so on? And then you have to do it with a view to making this realistic proposal to revenue. Now, if you're going to apply for a PPA, you will need to, as I say, complete the PPA form, but you'll need to back up your story as well. So you'll need things like a statement of affairs, income projections, bank statements, and so on. Because if you're sitting on loads and loads of money, and the revenue say, well, hold on a minute, why don't you just pay it all off? I mean, what do you need that money for? You're not hard pressed, and it's all payable. So you'll need to be able to make your case. So there's a good bit of planning involved in this over the next few weeks. Now, bear in mind the next few weeks as well, we'll bring on the other dreaded point, the annual income tax filing deadline. So to a certain extent, you'd nearly look at it all as one project if you have warehouse debt, in conjunction with your income tax deadline coming up on the 16th of November, that you would actually look at this whole warehousing issue as well. And it's just worth bearing that in mind as well, that, and I've said, I know I've done this session the last few years coming up to kind of income tax season, and I've always made the point that when the day comes, and unfortunately now it is coming in the next couple of months, that the warehouse is repayable, any solicitor or indeed any taxpayer who availed of the warehousing for their income tax filing in November 20 and November 21, they've effectively got 3 income tax deadlines in the next couple of months between Halloween and Christmas, because you've got your normal pay and file deadline in November, and then you've got the 2 that you warehoused that you have to deal with between then and New Year's Eve. And who knows, you may have warehouse, in addition to your own personal stuff, you may have warehouse some of your practices, VAT and PAYE liabilities as well. So it could be a significant issue. I've used this example, I think, the last couple of years, so I'll just use it again this year with updated to it actually being a moment of the actual moment of payment, or a moment of truth, if you will, here. Our solicitor in practice who had all of these liabilities in 19, 20, 21, and he qualified for warehousing and availed of it in November or December 20, and again in November 21. So he's effectively warehoused possibly a balancing payment for 19, all of his 2020, because he could warehouse preliminary back in December 20, and then he could warehouse again in the following year, and he's warehoused his preliminary 21. So he's effectively warehoused, the simple way of thinking about it is he's warehoused two sets of payments. The tax he would have been paying in December 20 and again in November 21 has been warehoused. And we see there an example. He's managed to warehouse €240,000 worth of debt. So this is a solicitor who's on between 100 and 150,000 a year of liabilities. Sorry. So, so he's warehoused about 240,000 and suddenly becomes payable. So what has he got facing him in the next couple of weeks? Well, in November, he'll have to face his tax payment for November 22 in the normal way. So he'll have to make a balancing payment for 2021, which is essentially whatever his 21 bill is, minus the preliminary that is stuck in the warehouse. He'll have a small top up to make for 21, but he'll also have to pay his 2022 preliminary, which could be based on possibly, in our example there, 100% of last year. So he has to make a chunky payment there as normal in November, but then he's got this €240,000 coming up on New Year's Eve. So he's got a total of 350 facing him over the next couple of months, plus if he's warehoused any VAT and PAYE. So obviously for him, planning for this is important, that November 21, sometimes you could focus on the warehouse and overlook your November 21, because November 21 is very important in its own right, obviously, but also one of the conditions to stay in the warehouse between now and Christmas, but also then to stay on a PPA if they grant you one, is that you keep your current taxes filed and paid up to date. So you'll also need to factor that into your cash flow, that you kind of will have to ensure that you keep paying your routine kind of payroll and VAT returns up to date into 2023 and so on. So it's worth doing that exercise, because sometimes you can be dealing with big numbers here and it can be a little bit daunting, I suppose. So but with the careful planning, obviously it is doable. I mean, Revenue are not going to, they're not minded to put people out of business. So they are always there to have. I mean, if you go back to pre-2020 and apply the old rules there, if you will, provided you were realistic in what you were proposing and provided that you were genuinely in a situation where you needed that little bit of leeway, they're willing to play ball as well. But the critical thing here is the early engagement and the careful planning,
Listen, Michael, unfortunately, we've covered a lot today, but we're out of time. So thanks for giving us your really in-depth knowledge of what's happening. And there's quite a bit in that tax warehousing stroke tax deadline return. So I think it's time to get in touch with your accountants, and don't hesitate to contact the Revenue if you're having an issue. I mean, I wouldn't put your head in the ground, but obvious advice. If you just scroll on, I'll just introduce the upcoming sessions. Thanks everyone for joining us today. If you wouldn't mind just roll on the slide there. Of
course, yeah.
Or Michael, sorry. So in 2 weeks' time, we're talking about guide to e-voting, and then October 26th is back to PII time, and we're going to have an update from Bill Holohan, and then Finbar Jeffers from O'Leary the following week. And then the 6th of November, we're going to be talking about applying to be a judge. And then on the 30th of November, we're going to be talking about thinking of retiring. So again, Michael, thanks a million for joining us today. There was more in the budget than seems, but it seems like we got a lot of it in advance. So thanks for taking the time, everyone, to join us today. Slán.
Slán.
Michael.
Justin.